Good morning, ladies and gentlemen, and welcome to the FLOWTECH FLUIDPOWER PLC half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, all questions submitted today will be reviewed, with responses published on the Investor Meet Company platform where it is appropriate to do so. Before we begin, I would like to submit the following poll, and as usual, if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to CEO Bryce Brooks. Good morning, sir.
Yeah, good morning. Thank you very much, Jake, and good morning to everybody joining us this morning. Our presentation today is broadly in sort of three sections. For those who don't or aren't familiar with FLOWTECH, I'll try and give a quick canter through some of the basics of our organisation and what we're about. I'll then pass over to my colleague Russell Cash, CFO, to talk through some of the financial information that we've disclosed this morning. And I'll then follow in that with some of the strategic developments and outlook that we see for our marketplace over the coming sort of 6 months plus. So without further ado, in terms of our fundamental offering, everything remains broadly the same. As some investors will know, we operate in a very fragmented marketplace, many players in our marketplace. Of recent note is Diploma PLC have acquired an organisation called RG Fluid Power, who operate in certain aspects of our market, but are more predominantly in industrial tube and fittings. That was a recent transaction. We operate in the three countries, the Netherlands, Ireland, and obviously the UK. Our capital structure is something that's proven to stand us in good stead over recent years. We've come through pandemics, supply chain issues. We've recommenced dividend payments this year, all without recourse to any external funding requirements and all within our own sort of facilities. And we'd like to think we've got a leadership team that has some experience and skill sets. Talking of the leadership team, obviously myself as Chief Executive, I've been with the organisation since 2010, previously as CFO, but Chief Exec since 2018. Russell joined me in 2018. Many of you will know Roger McDowell through many other investments of which he's chairman of. Nigel Richards, our senior non-exec, been with us since floating 2014. And then during the course of this year, we've added the skill sets of Jamie Brooke and Ailsa Webb as non-executive directors who brought considerable additional skill sets, both operational, commercial and financial. So we feel our board is now very broadly based. And certainly Russell and I are very pleased with the input that we get from our colleagues. Overall, we are the UK market leader with around 20% market share of the fluid power distribution market. We're a trusted partner for both customers and suppliers, and we're a specialist distributor of components and services in hydraulic and pneumatic components, with hose fittings and valves filling certain aspects of the industrial side of things. Crucially, though, and underpinning our digital strategy, is we have thousands of touch points to our sector, both as customers, suppliers, stocking, and in terms of the locations. We'll talk about some of the productivity improvements that have come through, but overall, we still operate out of 16 locations in our home geographies. The key suppliers that come through to us are all the major global brands. Parker, recently with the acquisition of Meggitt's, is now at 30 billion turnover, but one of the cornerstones of the global marketplace in pneumatics and hydraulics. Bosch Rexroth, many people will know of. Danfoss have recently acquired the hydraulics arm of Eaton, so now operating about 7 billion euros. So there's some very significant players in this marketplace. Valvol and the Interpump brands from Italy. We have representations of all the key partners in this particular sector. The pneumatics and hydraulic industries are very widespread in their bias. Pneumatics particularly so across a number of industrial sectors, food processing, electronics, medical, whereas hydraulics has a bias towards the construction sector, about 40% in that particular side of things, and a broad split between what we call mobile hydraulics, so an application on things such as a JCB, a piece of plant, and industrial application. So, for example, in a bottling plant for moving forward. Overall, our organisation is owned with the investment funds shown on the screen, about 64% covering the top 10. Very solid register, very growth focused, all of whom are now long-term players in terms of their position with FLOWTECH over the last 3 to 4 years. So in terms of moving through to some of the financials, I'll hand over to Russell to provide the headline financial and trading review.
Yeah, thank you, Bryce. And good morning, everybody. So this is my slide up here, the first slide. Yeah, so in terms of the headlines, from the top down, first of all, on revenue, that increase of 2.2 million is 4.8% on a like-for-like basis. And across our segments, and Bryce will touch more on this in a subsequent slide, that's 1% up in FLOWTECH, 6% up in solutions, and 12% up in services. We'll talk a little bit about the price volume mix a little bit later, and equally we'll talk about how those respective increases compare with what our industry stats show. Without stealing Bryce's thunder, the performance of FLOWTECH at only 1% is actually not bad at all, but we'll come back to that. In terms of the gross margin, this is, I think, the 8th time I presented either full year or half year results. As Bryce briefly alluded to, I arrived at the very back end of 2018. And one stat that does stick in my head, because it's part of our DNA, is the quality of our GP percentage, which has up until now varied between 33.8% and 35.7%. So it is pleasing to see 36.3% being presented, but we're not patting ourselves on the back too much on that, because of course you'd expect us to be knocking it out the park on the GP percentage when there's the inflationary pressures that the broadcasters seem to remind us about every evening of every week nowadays. But that is part of our DNA, and it is nice to see that trending in the correct direction. In terms of our underlying operating overheads, again, there's a slide a little bit later, but we are pleased that we contained the headline increase to 2%, when people are now talking about 22% inflation last night. I caught a glance of the news. And the reason that we've achieved that is because with what we've done and what we're about to do, our headcount will be down by circa 8%. And if we look back over an 18-month, 2-year period, we've decluttered and simplified our property estate. There's 8 properties that have left the P&L account. So it's for those reasons, essentially, that we contain the increase to a very modest 0.2 million. So when we add that all together, of course, we get a not insignificant close to £1 million improvement in our underlying operating profit. So again, trending back to the sort of number where we wanted to ultimately get to. Debt, I'll say a little bit more about on the next slide, but suffice to say, whilst it's gone up, it's very definitely under control, and it will very definitely come down in the second half of the current financial year. So I seem to be lucky enough to always have pretty simple debt bridge graphs, to be honest. So there's only 2 bars that are really worth talking about, but perhaps that's a 6-month debt bridge. But if I just reflect on a 12-month period, which in some ways is obviously more meaningful, in particular when you think about the receivables element of the debt bridge, and the debt's gone up by 6 million, but our inventory has gone up by 11 million. So obviously, in simple terms, we're doing something right, which is reflected by the biggish green bar there. So we're generating nice cash profits, but we chose to invest a chunk of that into our inventory book. And 11 million, 35 million, I think, versus 24 million 12 months previously. Again, pretty significant, but very deliberate, and it will begin to unwind in the second half of the year. And that is the single biggest reason why I'm confident that obviously combined with a continued green cash profit bar will deliver debt reduction, certainly in H2 of this year and probably into 2023 as well. Well within the banking facilities and fairly obviously covenant compliant. Just before I hand back to Bryce for the meat and the heart, I guess, of the presentation, the what we do next piece really, just on the capital allocation policy, we did reintroduce our dividend at a materially more modest level, 2p in respect to 2021 performance. I think pre-pandemic it was at over 6p per share. We felt 2p was a more sensible balance level. So we do respect the desire of some investors to receive dividend income, but that's not our focus. Our focus is on managing our debt position. And whilst we're right here, right now, at perhaps the upper end of that 1 to 2 times EBITDA metric, that's fine. And as I said, it will come down. Underlying EBITDA is about 10.5, 11 million. So the fact that we're at 19 is fine. That's our focus. And in terms of inorganic growth is a term there, we're certainly not hunting out acquisition opportunities, but equally it'd be wrong of us not to have a look at stuff if it does hit our desk. But that's not what it's been all about in the last 4.5 years. It was 4 years of acquisition activity. There's been 4.5 years now of simplification, decluttering, clarifying the positions. So all in all, I guess if the head teacher was given a report, we think we've done pretty well, an encouraging performance, if you like, albeit there's still, unfortunately, a degree of disruption in the classroom.
Okay, in terms of the sort of segment analysis, in some respects, the performance of FLOWTECH against our original aspirations at the start of the year could be seen as slightly disappointing. But we have to put that in the context of the overall market, illustrated by the industry stats that have come through from our industry body, the BFPDA. FLOWTECH is a sort of 30% hydraulics, 70% pneumatics and industrial organisation focused on MRO. So it's clear that it's comparative in 2021, when we had pretty strong rebound from the COVID conditions of 2020. Was maybe slightly ahead of maybe where the underlying market sat, and that's been reflected in some of the settling back in those pneumatic segments, particularly in sort of Q2. In parallel to that, hydraulics has equally performed very well during the course of this year, and that's where our solutions organisation sits almost exclusively at 100% of its activity. And you can see the numbers yourselves. Now, these are not volume, these are purely sales value underneath that, in order to reflect the inflationary trends at product set level, which we estimate is between sort of 5 and 6% full year impact. You can work out the balance therefore in terms of sort of overall volume metrics. So pneumatics is down at sales and more heavily down at volume. Hydraulics is up in terms of overall volumes, but the majority is through price impacts. But across our organisation, we think we've handled both of those things fairly well. Margins in all our areas are up significantly, and the highlighted performance is clearly in solutions, where it's achieved 13.9% contribution in the first half, well beyond the sort of target of 10% we saw as the sort of long-term minimum expectation. FLOWTECH dipped below the sort of 15% benchmark, but as we'll talk about in the second half, it's announced the closure of its Leicester warehousing operation. The commercial function there will relocate into a local office environment. Once that's enacted through our accounting position, then we're pretty confident that that'll bounce back to above the 15% benchmark. And with a strong performance expected now from services, with a deliverable order book in build, we expect that again to achieve its own minimum benchmark of around 10% certainly in the second half. So whilst aspects of this are slightly disappointing in terms of the overall performance, underneath that we are actually very pleased when it's compared with the comparatives. And we believe again we've achieved above market share gains overall. In terms of moving forward in terms of our overall strategy developments, the sort of key planks of what we've been trying to achieve over the last 3 to 4 years. Just to remind everybody, we took a disparate 26 site, 16 trading brands, a group of independent trading profit centres that was fit for purpose exactly for its market. But our view was that with the increasing online presence, the Amazonisation of life, use of digital information to connect together the 11,000 customer set, that we had to change our strategy. And we've been focusing very clearly on creating two very clear offline brands in FLOWTECH and the Fluid Power Group, enhanced by a single online presence of FLOWTECH, all revolving around a single product set. So in terms of the major developments during the course of this year, we told all that on the 4th of January this year, we created a single FLOWTECH organisation by the aggregation of the legacy brands that it had, and creating a one-stop shop for all that particular customer set, over 50 million of sales, operating through one e-commerce site, through 3 logistics centres at the time, now through 2, following the closure of the Leicester site. In July of this year, that was enhanced with the integration of the team from the former Primary Fluid Power Components Group. This is a hydraulics offer, and therefore creates a much broader base to that segment of the FLOWTECH operation. Again, now all are on one system, operating through effectively one site. And we've been able to introduce their 20 new hydraulic ranges to the previous extensive offer that the FLOWTECH organisation had. So again, another big step forward in our strategy on the 1st of July this year. Behind that, we've talked about the fact the Fluid Power Group is now well advanced in its creation. All the structural work is now complete, and will continue with the rebranding during the remaining part of this year to create a single brand, but focused around 2 particular segments of the marketplace, endemic across how the hydraulic sector is viewed with mobile and industrial applications. And again, all of which are enhanced with productivity gains that can be garnered from driving small accounts through the online presence flowtech.co.uk. So all the businesses within this sector currently have no online presence at all, other than information-only websites. So we see we're going to get a natural marriage between the capabilities that we've got across the group. That is now all enhanced with our new website, which went live on the 17th of May and has gone through subsequent revisions of new extra bells and whistles, so to speak, coming online. And we expect by the end of September, 9 sprints will have been introduced to further enhance its capabilities. It was slower in terms of introduction. We spent a lot of time making sure its integrity was strong. We've now gone through 3 months post integration, dealing with various, minor teething problems, but we're very pleased overall with the resilience that is now being shown. Yet improvements can continue to be made, but overall that is in play, and it's now for the first time allowing us to enhance some of the search engine optimization techniques that previously we weren't able to use. We started to put these live in the early part of August, and we're certainly encouraged by the initial reaction that we've had. So average search rankings are starting to improve from a pretty low base, it has to be said. And since inception in early August, again, we're quite pleased. As ever, this has to be a relentless part of what we do. It will not be a one-stop fix. It's going to take us months and years to properly get to the positioning that we believe can be achieved, but we're now on that particular journey. In other areas of activity, as Russell's touched on, the work that we began in early 2020, obviously at that point we didn't appreciate just what was going to come in the difficulties that the COVID-19 period fought for this. This was all about warehouses, predominantly warehouse pickers in terms of headcount. Our commercial colleagues are incredibly valuable, as a sort of resource. But the work that we've done is now starting to bear fruit. So we're now down at about 605 headcount. We've got a further 17 headcount reduction in Leicester that's been announced and is now in process. So we think we'll be down at sort of 590 into Q3. And thereafter, there's a sense that natural wastage will allow us to improve productivity, over a period of time. But by the centralisation of a lot of our activities around the Skelmersdale campus, we believe we're able to further improve that. As we've talked about here, 8 sites in total have been removed. It has to be said, it's now dealing with a considerable additional stock holding burden that's been a necessity out of the supply chain disruption we've seen post-pandemic. That's meant we've got considerable overflow stock holding, particularly in the northwest of England, but all areas that we believe we can deal with. We've shown resilience both in our commercial activities and in terms of the capabilities of our management team over the past 3 years, and that'll be further reflected in our 2022 late half-year performance and into 2023. So overall, the key planks of what we're looking to achieve have continued to be put in place as we strive to ensure that this platform is in place. 2 offline branding styles, Fluid Power Group and FLOWTECH, and a single online trading platform, flowtech.co.uk, that has the capabilities to go further afield into Europe under that same infrastructure. In terms of our key achievements, yes, we've grown operating profits with solutions achieving record highs. We've improved our gross margin. Yes, there's an element there of selling old stock at new prices, but what's very pleasing, if we look at August as a snapshot month to date, our margins are above where they were a year ago. Our business trading platform is now built and in live and will be relentlessly improved as we sort of move forward. We've integrated our FLOWTECH organisation under the 5-to-1 project, and in terms of overall productivity improvements, picking efficiencies, buildings and infrastructure, a lot of that work is now complete, and we look forward to the second half of the year and ensuring that we complete that particular programme to leave us, I would say, with a fresh platform for the start of 2023. In terms of outlook, obviously we're all aware of the current widespread uncertainty. Our focus remains on ensuring the key pillars of our long-term strategy are in place, and will ensure that we maximise all the opportunities to protect our profitability and ensure that the risk environment that we currently face we can deal with. I think we've shown that since the start of the pandemic period. As I say, we came through that without recourse to external finance. We've operated within our means. We've used our capital wisely. We've got the most extensive stock holding position that the group has ever had, and certainly our sector has ever had, and will ensure we continue to use that as a position of strength moving forward. Okay, overall that completes the basis of our presentation. Jake, if I could pass back to you to see whether we've got any Q&A coming through.
Absolutely, Bryce, Russell, thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team takes a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Bryce, Russell, as you can see, we have received a number of questions throughout today's presentation, so thank you to all of those on the call for taking the time to submit their questions. If I could please just hand back to you to run through that Q&A tab, and where appropriate to do so, if you could please just read out the questions and give your response, and then I'll pick up from you at the end. Thank you.
Okay, well, Mark's asking the question about supply chain. In terms of improvements in supply chain, there are 2 elements to this. There's the length of lead time, and there's the volatility. In other words, you place an order for 6 months' time, and in 6 months' time, the supplier says, sorry, we can't send it. It's going to be another 3 months, and you're only going to get half. So I'll deal with the first element of that in terms of lead times. No, we're not seeing any improvement, but overall, at least they are consistent, so you can work within them. That means you have to, yes, keep more buffer, but at least our major supply partners are acting consistently from that perspective. If I then deal with the volatility aspect, for those elements that come from China, which is about 25%, again, I would say that is pretty consistent now. So again, we can operate within certain defined parameters. In terms of our European partners, say 75% of our supply, again, that has some consistency, but to some degree, there is still a rationing almost aspect. So if you place orders for 100%, we're getting fairly early warnings that, yes, we might get 70% of it. Now, that has a knock-on effect straight through into particularly our OEM partners in solutions. So has it improved? Yes. Is it improving in terms of allowing us to significantly reduce our stock holding position? I would say no. There's still quite a lot of work to do in that particular area. Russ, you deal a lot with the sort of stock side of things. Is there anything in particular to add to that?
No, there's a second element to Mark's question about what can the company do to ensure it meets demand. I think the only thing I'd add to your answer, Bryce, is that we do have a lot of people with layers of technical expertise within our organisation. So there have been examples of where a customer has traditionally required, component A, B, C, but our guys have been able to say, well, I know you've used that for the last 10 years, but why don't you try component P, Q, R? It'll sort of do the same job. So we've sort of had some creative thinking and worked effectively with our partners, our customers. And if anything, by doing that, of course, it strengthens the relationship. So as I alluded to earlier on, notwithstanding what Bryce says about it's still a challenge, but at least it's a consistent challenge. We do have different layers of planning in place to achieve an inventory reduction, to obviously assist with the debt reduction in the second half year, notwithstanding what Bryce has alluded to. We signposted a few years ago, pre-pandemic, an ambition to achieve, we called it a turn and earn index of 130, which was the multiple of gross margin and stock turn. So therefore, the ambition on stock turn was 3.5 or thereabouts. And that remains the case, to be honest. The fact that we're, somewhere between 2 and 2.5 at the moment doesn't mean we can't get there if or when the world ever becomes normal again.
Okay, in terms of the timing and passing of input price increases, again, there are different aspects. One thing that it's probably fairly easy for people who aren't familiar with us to think is that we have a narrow group of products. Our price goes up, we pass that through because we're the only source of supply. Well, in reality, we're not. It's a huge range of products from a very widespread number of suppliers. And in many respects, key customers, particularly in FLOWTECH on the MRO side, have direct supply relationships with many of those major manufacturers themselves. So we can sort of fill in for the embarrassment stock, type of item. So you've got wide breadth of stocks. You're turning your stocks twice a year. If your price comes through with an increase from, say, Danfoss, and you're sat on 3 to 6 months of stock of that particular product, you may choose not to move that through if the market isn't quite going as quickly with it. However, you may have a situation where you're the sole source supply to an OEM and the product is scarce. And if the supplier puts the price up, you put it straight through, to the manufacturer on the other side. So just to remind everybody, we have no contractual committed pricing positions with any of our customers. All is by commercial negotiation, depending on, other sources of supply. But if you wanted a very broad sense of how quickly we can pass things through, it would be between, say, 1 and, say, maximum 6 months, depending on the depth and the breadth of the stock that we've got. So if you look, since strong price pressure started to kick through probably back end of Q3, certainly Q4 last year, we've been progressively moving prices through. Even in Q2, there were several suppliers increased prices again. They were all passed through on the 1st of April in parts of the sort of FLOWTECH range. Again, Russ, anything else?
No, I think the key point is the fact that we're not bound into any prices. The art of the price setting is something which the guys consider on a daily basis, really.
Again, in terms of visibility, FLOWTECH has very little visibility. Probably 90% of its sales are tomorrow. It's a next day offer. It does have elements of its order book with some pneumatic customers that back to back with OEMs themselves. You get a little bit of foresight there. Solutions, a lot of that is supplying into OEMs, so it may have 1 week to 3 month sort of production schedules that we have to provide kits through. But again, it's not a committed order. It's a sense of what they want us to stock, and they can remove that advice at pretty short notice. But there is some sense of visibility there. So solutions moving forward. And then in services, yes, there's an element of repair in some of the work that the on-site teams do, but probably about half its sales, it has decent visibility of what's required with deliverables. We use the term scheduled deliverables in the second half of this year, gives us quite a lot of confidence about the financial performance there. But ultimately, you can make a £20,000 hydraulic power unit with a scheduled delivery of the 4th of November. And if the customer says, actually, no, can you now deliver it and make and deliver it in December? You've got to try and work within that. So yes, we do have a decent degree of visibility there, but none of it is particularly, I'd say, a contractual committed position. It's what we're used to working with, and that's within the nature of being a wholesale distributor. In terms of the features and functionality of the e-commerce website, the old website, if we could use that terminology, was pretty much an order portal through to our long-term customers. They were used to it. They would know their particular products. They could input fairly quickly and efficiently. So a huge change, that is now an all routes to market sort of website, is the ability to search for products. That in itself isn't transformational. It'll take a longer period of time. So as the SEO work kicks in, we get an improvement in our ranking positions. We'd like to pick up more of the sort of floating search-driven sales. So many aspects of its capabilities are focused in around those particular areas. There are particular changes that will help with our current customer base. So the scheduling of call-off orders. So we do have certain customers who like to place bulky orders that they can pull down from on a monthly basis. There's much more functionality that's been added from that particular aspect. But probably the bigger change, the sea change, is actually in the engineering underneath this. The capabilities of attaching this website to multiple ERP systems is now much more fluid for us, if you excuse the pun there. The ability to connect that to the databasing aspects, the marketing campaigns, the personalization software. Fresh Relevance is a product that we're working with and on. That's probably the key bit. So it's the lead generation work, both in offline sales, email marketing campaigns, and the exciting element for me is in our offline world. I never lose focus of the fact that we're 120 million turnover business that's earned its bread and butter over decades dealing face to face. So it's the offline lead generation that I'm actually quite excited about, making that a much more efficient proposition. And that's where the CDP, the customer data platform, and everything that comes with it, we're excited is now starting to come on stream and will give us some very positive, let's call it, information in Q3 and Q4 as it starts to come on stream. And therefore we take the online touch points, that come through the new web architecture and all the capabilities with the offline data points we've got through a streamlined organization. So we've got a lower number of systems now. The FLOWTECH now with primary has 60 million of sales, circa 4,000 customers live, something like 10,000 customers over the last 3 to 4 years. And I was quite staggered with some of the initial feedback from the CDP, which has gathered 10 years worth of data. And there's something like 47,000 customer records that we've had touch points with across the organization. That's the bit that's actually equally exciting, on top of, let's call it, the transactional capabilities of the new website. What are the targets around percentage of online sales? Well, I'll reiterate, as an organization in FLOWTECH, it's always taken in total now, about 56% of sales through online means, but it was a pure order portal with established customers. We believe that will increase obviously from 56, and overall target may be around sort of 70. But probably more pertinent is just in the UK and Ireland, we believe there are about 60 million, so circa 5-6% of the total market that is a pure search-driven transactional sale that previously we did not have access and exposure to. So we're going from effectively nil market share there to hopefully something that's considerably, north of that. However, if you also throw in that in European markets, our online presence is effectively nil at this current point in time. So by building an infrastructure around a single PIM, product information management system, that is populated with the digital media of all our major supply partners, again, is quite exciting in terms of the organic growth that could play when we expand across all the geographies. Clearly behind that, you've got to have the operational infrastructure to support that. But our view is, let's start by getting very strong and tight in the UK and Irish markets. Let's get our online platform working efficiently, and that gives us plenty of scope for organic growth in the future. Energy bills, Rust, maybe want to?
Yeah, I mean, the headline answer is relatively, stress the word relatively modest. It's not like we make a load of stuff. About as complicated as it gets is, assembly of power pack units, but not seeking to underplay it. And so it's relatively modest, measured in hundreds of thousands rather than multi-millions. But clearly, when we look forward, if that's the right expression, to 2023, we feel we've done a pretty good job of managing the 2022 inflationary pressures. We're probably going to have to do an even better job of managing the 2023 inflationary pressures. We have been working for years, actually, with a specialist organisation to ensure we get the best deals from utility providers, but clearly the best deal you can get in back end of 2022 looks awful to what you could have got a couple of years ago. So we're alert to it, we're managing it, relatively modest, measured in a few hundreds of thousands rather than multi-millions.
Mark has asked about FIFO accounting flattering profit growth. This is my comment about selling old stock at new prices. Undoubtedly, there has to be an element of that feeding in. I've been in wholesale distribution for sort of over 25 years. You love inflation, from that aspect. But the bit that gives me, like I say, some sense of confidence is we're very particular about tracking gross profit margins, percentages, year on year. In other words, comparing exactly. So we're at day 21 of a 22-day trading month. Russell and I know exactly where our GP percentage sits against exactly the same working day a year ago, and we've disclosed in our RNS that we're at or above that particular rate. So, given as our stock turn is just over 2, and a lot of our stock is relatively new in the last 6 months plus, given as we're now in August, we're not selling old stock at sort of new prices to some degree. We're selling what has been acquired, post the inflationary period into current marketplaces. There's always a sense of have we been overly aggressive in matching that through? Could we maybe slightly depress our price and margin expectations to pull some of the strong stock position that we've got through? But that's in the nature of being a distributor. You have to balance those particular things off. That's a business as usual activity. I would say in a set of circumstances that aren't particularly business as usual, but we're getting pretty much used to that, over the last sort of 2 to 3 years with everything that's been thrown at us. Russ, you want to give maybe an accounting
just our
answer?
guys are sort of, it's within their DNA to manage pricing and margins all of the time. It's not like they're reluctant salesmen who get nervous about putting up the prices once a year. It's the art of setting the prices and protecting the margin, which, as Bryce alludes to, is very much within the fabric of our DNA and the organisation's DNA.
What are our ambitions in Europe? Well, before we reset strategy, there was plenty of M&A options for us in sort of near Europe. But we're all aware of when we do M&A, we have to be very concise in our plan, use of capital, integration. That's probably a bit of a sea change in our attitude towards the way we go about that. But I touched on the fact that whilst our new website in itself, the transactional capabilities are an improvement, ultimately it's the bigger picture for us. It's the ability to bolt our infrastructure onto both other ERP systems, but equally amend it to be pertinent to other geographies. And the fact that that same infrastructure, that same product set is global, universal. So clearly near Europe in particular has to be a target in the medium to longer term. And what's interesting, we touch on the fact that in the Republic of Ireland, we've had some sales struggles there. The sort of friction of paper processing, in particular, the major carriers have struggled to deal with that. I think FLOWTECH as an organisation, if there was one area of hindsight, we probably could have dealt with that better. We're always self-critical. But what's actually impacted is the fact that European distributors have offered a 3-day service into the Republic with an online trading platform that's starting to show post-pandemic how this is receptive to the typical user. 3 to 5 years ago, the market would have said, no, it's not an online play. Well, our strategy was that it's not an online play now, but it will be. And again, reinforces why we believe we're on the right track here. So that says to me that can be done in reverse. Once the situation is cleaner, we're better at processing the paper, so to speak, which we can do. That's a solvable sort of problem. So it's very much our ambitions in Europe are based around online trading capabilities, possibly using third-party logistics contracts, to prove up the model until we've got some cleaner numbers out of there. How insulated are you to a tough recession? Well, I would say 2 areas here. In my time in FLOWTECH, I came in just after the credit crunch. We've obviously seen the pandemic. I'd like to think that our sector has shown its resilience through that particular piece. Yes, if we sell less, operational gearing dictates that profitability can go down, but equally we throw off cash. Again, highlighted, to almost an extreme measure through in 2020 when we created a considerable amount of sort of cash. Our sectors are broadly spread. Yes, hydraulics has this sort of 40% construction sort of bias. So if you believe that the recession will deeply impact construction projects, that may sort of feed through. But across the piece, it has a finger in many, many different pies. Our largest customer is about 2% overall of our sales register. So again, we've got resilience there. We've shown through the credit crunch and through the pandemic, strong cash collections. We always touch wood at this particular point in time. And I always take comfort in the fact my colleague is a former esteemed insolvency practitioner in terms of dealing with cash flow from errant customers, from that perspective. So we have defensive characteristics that we've already displayed. Insulated, I don't think anybody is insulated from a tough recession, but we can manage, certain elements of our cost base accordingly, and we will do so. Anything you want to add?
No.
That particular aspect?
No.
You said that your larger customers often buy direct from manufacturers. Does your 20% market share include this, or does it refer to just distributors? It's just distribution. It's always been the sort of received wisdom that circa 50% of a total sector is through distribution. We're almost like the necessary evil. All distributors would absolutely love to transact directly with their end user, cut out the middleman. But since the dawn of time, they equally like to manufacture in huge quantities in low-cost environments, and particularly in MRO applications and in sort of C&D parts supplying to OEMs, they need distributors. That's why we exist. Our objective has always been to be the best of that. The lowest cost provider of a quality service is the mantra that I've always sort of worked under, and nothing particularly changes from that perspective.
Just the only thing I'd add to that is certain of the larger manufacturers have gone on public record and said that there's a stated intention to transition more of their product through the distribution channel. And helpfully, from our point of view, that's sort of their brand in the hands of what they would view as reputable, sizable organisations in different geographies that have, state-of-the-art web capabilities. So we'd like to think we tick most of the boxes that those huge organisations are looking for. So it is 20% of half of the overall £1 billion market, but that could switch to, I don't know, 45, 55 in our favour over time as some of that sort of begins to be seen.
In terms of a bit more colour on the Irish market, I've sort of touched on this. In essence, for a number of years, the FLOWTECH division, ex-warehouses in Skelmersdale and Leicester, could easily deliver sort of 4 o'clock cut-off delivery next day, Dublin, Belfast, maybe pick up Cork, and we did 3 million plus of sort of sales through sort of small parts. Obviously, come into the pandemic, pop out the other side with the new Brexit conditions. At the same time, we switched all our delivery activities to FedEx, who did all our English distribution. We went with their service offer into the Republic of Ireland. And you've got sort of 2 impacts, really. The paper processing drag, I think we could have dealt with maybe more efficiently ourselves, but that's the reality of what took place. Add to the fact that FedEx themselves have had difficulties that I think has placed them behind maybe what the competitive product has done with their own integration of, for example, the TNT acquisition they did. The juxtaposition of those 2 facets has meant that we are down, quite considerably, probably as high as sort of 25%, plus in terms of that Irish sort of marketplace. So both of which, the paper processing and the delivery offer, you'd think were solvable, and we're on with actions in those particular areas. But again, if anything, it's awakened the European headquartered distributor to the fact that they can offer into the Irish market where previously they probably wouldn't have touched it because they couldn't match a next day service offer. I'm even being quoted ex-Poland 3-day service, simple processing, invoiced in euros, has become an attractive proposition to previously somebody who wouldn't have bothered with that particular sort of offer. So just one of the challenges that we have had to face over the past sort of 18 months as it is now. Diploma's acquisition of R&G. Well, let's talk about R&G first. They're called RG Fluid Power, but actually if FLOWTECH's seed business was in pneumatic component distribution, RG's seed business is actually in industrial hose and fittings through the sort of Century and Millennium brands. They've acquired an awful lot of smaller distributors, 1 or 2 heavier transactions, just one in pneumatics and one in hydraulics. Pearson Hydraulics is a Danfoss distributor that they own. So yes, there is a competitive environment, but to some degree, almost like more complementary. As far as I can see, their stated ambition is around the one that we highlighted about a fragmented marketplace, a sense of aggregation. Diploma's historical methods are around buy and build, careful execution of sort of acquisition transactions. I think that's their stated position with Diploma. So yes, there are competitive elements to that, but they don't at the core have an online capability like a FLOWTECH. They do have online capabilities and they can develop them, no doubt. So they are, yes, a competitor, but not one that's right smack in the middle of what we do. Possibly of interest is the sort of multiples they're buying at, fairly stated multiples at sort of 4 to 5 times that they buy at. And while it's not stated, the inferred transaction valuation that was applied is sort of 10 plus EBITDA that they paid for the R&G business. So investors can to draw their own conclusions about, that particular transaction. Okay. I think we're sort of 50 minutes in. That seems to have reached the end of the sort of Q&A. So Jake, I think if you're hopefully still on the line, we can maybe hand it to yourself.
Absolutely. Bryce, Russell, thank you very much indeed for taking the time to address all of those questions that came in from investors today. And of course, if there are any further questions that are submitted today, we'll make these available to you immediately after the presentation has ended for you to review. And then we'll publish those responses where it's appropriate to do so on the Investor Meet Company platform. Bryce, perhaps before redirecting those on the call to provide you with those their feedback, which I know is particularly important to the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Well, as we say in our sort of headline quotes, we think it's a pretty solid performance in the first half. We've continued to develop the sort of key pillars of our sort of long-term strategy. We're fully aware and cognizant of, the uncertainty in many sort of market sectors at the moment, the macroeconomic sort of position, and we'll continue to react as required, to those particular sort of challenges. But we think we've displayed the resilience of our organisation, our sector, our management capabilities over the past 3 to 4 years, and we believe we'll continue to push forward, over the medium and the sort of long term.
Bryce, that's great. And Russell as well. Thank you once again for taking the time to update investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of FLOWTECH Fluid Power PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.